This video tutorial will look at ratio analysis, both as an introduction and in more detail at the concept of liquidity. So what is a ratio in finance terms? Well, let's consider that you're buying yourself a new car. You've got £200, your friend also has £200, and you spend your full £200 on this beautiful car here. It costs £200. It's your car. Your friend turns up at the gate on the same day as you do, and they look a little bit more impressive. They only had £200, but because they've borrowed £99,800, they've actually managed to buy the beautiful white Ferrari at the bottom. Well, actually, from a financial point of view, there's something very significant here. You own your car. You actually spent £200 on a £200 car, so it's 100% yours. No one else owns it. They actually only own 0.2%. That's a very small amount. As such, they don't really own their car. Maybe a bank does, maybe a very generous relative. Either way, they may be concerned about interest rates, having to repay that. You might just be interested in whether your car starts in the morning. So it means very, very different things. At £200 in different contexts. Now, any ratio that we look at, we need to actually put into context. A figure on its own, as a standalone figure, doesn't really mean very much. It could mean that the figure is a good thing, it's positive, we're happy. It could mean it's bad. Could also mean when we look at data, we don't really know what that means. We've got nothing to compare it to. So let's assume you're looking at your industry with a yellow cross here. If your performance is of a higher value than your competitors, then that might be good. If, however, it's lower than a competitor's performance, we might judge that to be poor. So the same figure could mean two things. Equally, our business may set us some targets. Our value may actually be below that target, so the performance isn't good enough, we need to improve. Or again, the same figure could be above targets. So again, the idea of comparison, comparing against different aspects is important. We might also look at trends over time. So if over the last 5 years, perhaps, your performance has steadily decreased to where you are today, that's obviously a poor thing. Maybe it's your liquidity decrease or profitability. Conversely, of course, if you find performance has improved over the last 5 years, then obviously that's a good thing. So one figure on its own doesn't mean a great deal. We need to actually put that into context. In terms of our exam, which is the AQA Unit 3, Buzz 3, you will actually find that for any ratio analysis, the exam board give you all of the data, all of the ratios you need on page 2 of the exam. Any data that you need to calculate will be included inside the paper. If it's not there, you can assume that therefore they're not asking about it. The key focus for the exam board is actually on how well you as a student can interpret that data, not so much on the calculation. There are marks for that. Some of the 10-mark questions are almost purely for calculation. But certainly your interpretation, 34-mark questions, it's important that you actually think about what this information means. And again, this is business finance. The calculator shown here is about as complex as you need. There's nothing dramatic here, there's no algebra, there's nothing that we have to look at which is particularly complicated. So please don't be frightened by ratio analysis. One of the things I like to tell students to do when they go into an exam is actually think about what the ratios are. There's 4 different types. I've marked L against the side of 3 of the ratios here, liquidity, the ones we look at in this video. So current ratio, acid test ratio, and gearing. Profitability ratio, the return on capital employed. We looked at 2 further ones at AS, which were the gross profit margin and the net profit margin. There's then the financial efficiency ratios, so asset turnover, inventory or stock turnover, payables, creditor days, or receivables, debtor days. So these are the 4 efficiency ratios. The final 2 shown here are what are called the shareholders ratios. So the dividend per share and the dividend yield. So those are the things that might look attractive or not to potential shareholders and investors. Now a way to remember these is actually to when you come into the exam, put them at the side. But how do you know what order these go in? Well, come up with your own acronym, but one that works for me is love life, people. Enjoy endless entertaining evenings, laughing, singing and smiling. If you can remember that phrase and then jot down the first letter of each of those words at the side of the page, that'd be really helpful. Sometimes the exam board might ask you to analyse the efficiency of a business, so you then know the 4, in that circumstance, ratios that you're going to use. It's no point using ratios that won't be relevant, won't get any further marks. So how might the data appear beyond page 2? Well, often you find financial information in one of the appendices. They're often dedicated to the 4 functional areas. Maybe in the text, but the example here actually gave you some of the ratios calculated already. So for 2 years, so again, that idea of comparison. You may also be given extracts of other parts of the accounts, so from those you can actually calculate further ratios. You can almost assume if data is given in this way that you might be asked to use it. The example would certainly waste time putting in data and information that won't help you to pick up marks. Alternatively, you might actually get a set of accounts where you've got to pick out the numbers that are going to be relevant for the ratios that you might be asked to do, or the analysis that you might want to do. So again, we have a full set here, both the balance sheet and aspects of the income statement as well. So again, they've missed off things that might not be useful, might be misleading for you. This example also has 4 ratios calculated at the bottom. So what is liquidity? Well, liquidity is the ability to turn anything into money. Cash itself already is money, it's the most liquid thing in a business. But there's also things such as stock or other assets, including some of our non-current assets. So being able to sell those things off and turn them into cash is the idea of liquidity. You'll see the running man here, or the walking man, or the lying down man, gives an idea of urgency. The acid test ratio, again put in red to show its urgency, is a measurement of ability of a firm to actually generate liquidity in a very short period of time. The current ratio considers liquidity over a slightly longer period if you had to gather money together. And the gearing ratio actually thinks about the very long term funding of a business. So actually, where does the money come from if we need to repay some of those debts? And how is it funded? So looking at the current ratio, what is the current ratio? Well, the current ratio expresses the relationship between current assets and current liabilities. As a reminder, anything labelled as current in business studies means less than 1 year. So these are assets that are held in the business for less than a year, and liabilities that are probably due for payment within a year. Now it might seem strange because cash will hopefully be held for a very long time, but the figure of cash, the actual value of it, the debtors and their particular bills, invoices will constantly be changing, and the level of stock, the physical items we have in stock, will constantly be changing. So that's what makes them current. You can see how our current assets are listed as inventories at £80 million, receivables or debtors at £30 million, and cash at £2 million, so a total of £112 million. Our current liabilities, which includes our payables, so therefore paying our business suppliers, comes in at £105 million. Another way to think about it, so how to actually calculate it, well, it's current assets divided by current liabilities, and that's expressed in relation to 1. So what would it mean here? Well, if we take our current assets, they're 112 million. We can ignore the million for now, because actually this is a ratio, it's one figure in relation to another, so the actual zeros aren't relevant. So it's 112 million divided by 105. We're looking at the value of our current liabilities, not the fact that it's a negative figure is pretty irrelevant to us. So 112 divided by 105 to 1 is actually what the ratio will be, and if we simplify that, therefore that comes to 1.07 to 1. Well, that's the answer. What does it actually mean? Well, it shows us that we have £1 and 7 pence in this example of current assets for every £1 of current liability the business currently has. So if all of our suppliers, our payables figure there and the current liabilities, ask us to pay tomorrow, theoretically we have £112 million worth of current assets that we can actually use to pay that. So we'd actually have some left over. So that's a good position to be in. Not bad for our current ratio. In terms of an ideal figure, it's difficult to say. It will depend on the industry the business is in. But anything over 1 is very, very positive. You certainly want it to be no more than 2, 2.5 to 1, because that might suggest some opportunity costs. We're holding a lot of stock, or we have a large amount of inventory, for example, in the business. So that could be wasteful. So what does this mean? Let's interpret this figure. So it shows how many pounds of current asset a firm has to pay its current liabilities. So CA current assets, CL is current liabilities here. So 2 to 1 shows there's £2 current assets for every £1 of current liabilities. A high current ratio, so if it's more than perhaps 2.5, 3 to 1, it might suggest we're holding too much cash. It could be reinvested in non-current assets, so it's opportunity cost. We could be using that for something else, even as something as simple as maybe some further marketing to improve our market position. Think about the nature of the business. If we are in retail, wholesale or a manufacturer, we have lots of stock. Therefore, it's likely that our current ratio is going to be very, very high because of that inventory we're holding. So we might accept that from a company which holds stock. We wouldn't accept it from a bank. If the current ratio is low, well, that might suggest we've got a poor liquidity position. Are we able to pay our debts? We don't have the cash or the stock to sell or debtors to pay us to cover those debts in the short term. Then we're going to have some problems with cash flow and obviously liquidity. So you might see those things tied together. Again, think about the nature of the business. A bank, for example, has no stock. So therefore, we wouldn't expect to see that as a significant aspect in this ratio. So we might find that their current ratio is that little bit lower. Key thing to think about is how we can improve this. So one way we can improve the current ratio is to free up some cash. So we could convert our non-current assets, some machinery, maybe some premises. If we own them, we could sell them, maybe sell and lease back, rent those premises again, actually to free up some cash. So we find our non-current asset value would go down, but we'd actually get that back as cash. So certainly in the short term, that's one solution that we could actually look at. Okay, so let's think about liquidity a little bit more. I've got two products here. One of Furbies, which actually are the toy of choice in Christmas of 2013. I'm sure it's a fashion, they'll disappear again. But the other has actually been shown as being one of the world's worst products. It's a Telephone Boxes of Wales calendar from 2014. And sales, I think, are zero as I currently speak. The fact they're advertised might help their sales, but there we go. Now, if I had a room full of these items and my life depended on selling them as fast as possible, I'll take the Furbies. They're easier to turn into cash. Certainly just before Christmas, when the shops are full and people are craving these, I could probably very easily, at a reasonable price, sell these off. Sadly, the Telephone Box of Wales probably wouldn't go the same way. So in terms of liquidity, we need to think about this and actually stock. Sometimes stock's easy to shift, sometimes it's not. Now, where the current ratio looked at perhaps our liquidity over a 2 to 3 month period, what happens if we need to get cash quicker? We can't necessarily rely on stock. It may take time to actually sell. So the acid test ratio actually discounts the idea of stock as one of the assets we might be able to use up. So it actually looks at our liquidity in a much shorter time frame. So again, big business, and you'll notice this time in orange I've actually highlighted the figures that we'll be using this time to think about the acid test ratio. So acid test, very similar to the makeup of the current ratio. We're actually looking at the liquid assets, however. So the liquid assets in this circumstance are actually our receivables, our debtors. Hopefully they're going to pay us within a 60, 90-day period, something like that. And the cash that we've got. Inventories are potentially something we could be sat on for a long time. An antique shop might have stock sat around for months, if not years. So we can't rely on selling that to pay our short-term debts. So we're looking at our liquid assets here. So we're taking away stock. And again, we're looking at that in relation to our current liabilities. Another way of expressing that is current assets minus stock over current liabilities to 1. Or alternatively, exactly the same thing, is cash and debtors over current liabilities to 1. So the figures we have here are cash and debtors, or current assets minus stock, are 32. We've got £30 million worth of debtors, receivables, and £2 million worth of cash. Now we're going to divide that by our current liabilities, and again this is the same figure that we looked at on the bottom last time, which is £105 million. Not so worried about the negative, that's just telling us the value of it. Again we express that to 1. So 32 divided by 105 to 1 will give us a figure of 0.3 to 1. So this means we've got 30 pence of liquid assets for every £1 of current liabilities. Well, as you can see, we've now got less than a pound, much less than a pound, to cover that pound of debt. So that doesn't look quite so good. Only 30 pence this time. So in the very short term, this firm would find it very difficult to get together enough cash, liquid assets, to actually pay off anybody that we owe money to, our current liabilities. So let's look at that a bit more deeply. So it's similar to the current ratio, but we take stock out of it, as stock sometimes can have a lower level of liquidity. We're focusing on the 2 to 3 month liquidity position rather than perhaps 6 monthly or within a year. Something to think about is the nature of the business. Tesco's, for example, are a supermarket, and as such they carry a very significant amount of stock. Inventory is a huge element of their business. You walk into a Tesco store, you're surrounded by it. Therefore, we might actually see that their asset test ratio would be very, very low. Certainly much lower than 0.5 to 1, it could be 0.1 to 1. However, for Tesco, stock for them, think about 2 to 3 months, they would expect probably to sell out what's on their shelves within that sort of period very comfortably. Things such as bread, milk, basic necessities might actually shift on a daily basis. Other items perhaps longer, but on average I would say that stock is very liquid for them. Other firms, however, have a much longer cash cycle. So a manufacturer, let's say making nuclear submarines for defence, may actually be sat on stock for a much longer period of time. Sheets of steel may be there for months if not years. Therefore that longer cash cycle means that stock is something that's very significant, and they're actually going to want a much higher asset test ratio. They want far higher cash levels and debtor payments that are due to actually help them to cover that. So when stock doesn't shift particularly quickly, we expect the asset test to be much higher. These days, modern stock control and EPOS systems are probably very happy for the acid test to be 0.4 to 1, maybe up to 0.5 to 1. Traditionally, it may have been much higher. Again, think about the nature of the business. So our final ratio in liquidity is gearing. Now, gearing for some people might not be a liquidity ratio, but for me it is. It considers the long-term borrowing of a company in relation to what it actually owns. So again, it's what we own against what we own. So there's two aspects we look at here: non-current liabilities, so the long-term loans of a business, in this case £400 million. For a private individual, this could be things such as mortgages or long-term loans. For a business, again, it could be loans over 5 years, or maybe over a year, as well as things such as debentures. Our total equity is essentially our shareholders' funds. So shown here, share capital of 159 million and reserves retained earnings of 8 million, giving us a grand total of 167 million pounds. So the ratio looks a little bit like this. It's not a mistake, non-current liabilities does appear twice, on the top and on the bottom. We're actually going to see what proportion they make of non-current liabilities plus total equity, so the full amount of money invested into this business. This ratio is shown as a percent, so it's not a pure ratio, so do bear that in mind. So let's substitute in some numbers. So non-current liabilities on the top line, £400 million, we're looking at the value of that, the absolute figure. On the bottom line, again, that 400 million plus the 167 that our shareholders have put in through equity. If we simplify that and multiply by 100%, we'll find it comes to 70.55%. So this means that 70.6% of the funding in the business is from long-term borrowing. That's the percentage 400 million is to the 567 of the 400 plus the 167. So it's very, very significant. 70% of the funding in this business is borrowed. This is what we would call high geared. How do we interpret it? Well, a high geared business, so anything over 50, and please note, as soon as you get to 51, it's not the end of the world, a very high geared business. It is relative, but technically over 50% is high geared. So you might be susceptible to interest rate changes. You got a lot of borrowing, so therefore it might be millions, perhaps billions of pounds borrowed. If interest rates change by a couple of percent, even 0.5%, that's quite significant to the outgoings of the business over a period of time. It might be less attractive to investors. Any potential shareholders might find if they invest in this business, any profits generated, gross profits, might find that a lot of that's being then paid in interest payments when some of our overheads later on. So there's less profit for owners because it's going back to the lenders in terms of interest payments. It might be more acceptable if this is a fast-growing and high-profit business. Fast-growing business may have to borrow to actually help them to support that growth. They don't want to overtrade. And a high-profit business may be trying to surge ahead with the market leader, and so therefore it might be acceptable for them to be borrowing to ensure that happens long-term. Unit 3, probably less likely to see that, but it's still possible. Think about the nature of the business. Low geared business, conversely, so less than 50%, and again 49% does not mean that they're risk averse, but certainly if you find a particularly low geared business, 10%, they're not really borrowing very much. They may be potential to, there's not huge penalties borrowing 10%, interest rate payments aren't very high comparatively. they might find that they're risk averse. They don't want to borrow, they're quite happy what they're doing, they're quite a staid and very conservative business. Maybe a little focus on growth. They're probably unlikely to be the market leader. Now there are some exceptions. Some of the large companies such as Microsoft, who've made a huge sum of money and actually highly profitable, find they can probably fund a lot of investment internally. But the nature of the business you'll find in Unit 3 won't be like that. So think about that low figure. So that's your introduction to ratio analysis and a look at liquidity.